Investing is one of the most powerful tools you have to build wealth and secure your financial future. Whether you're saving for retirement, a down payment on a house, or simply looking to grow your money over time, investing can help you achieve your financial goals. But for many people, the world of investing can seem intimidating and complex. With so many options, strategies, and potential risks, it's easy to feel overwhelmed. In today's video, we're going to break down the basics of investing, providing you with a clear and straightforward guide on where and how to start. Before we dive into the specifics, it's important to understand what investing actually means. At its core, investing is the process of putting your money into assets, such as stocks, bonds, or real estate, with the expectation that these assets will generate income or appreciate in value over time. Unlike saving, which typically involves setting aside money in a low-risk, low-return account like a savings account, investing carries the potential for higher returns, but also comes with higher risks. The goal of investing is to make your money work for you, growing your wealth over time through the power of compound interest and market appreciation. One of the most important concepts to grasp as a beginner investor is the relationship between risk and reward. Generally speaking, the higher the potential return on an investment, the higher the risk involved. Stocks, for example, have historically offered higher returns than bonds, but they also come with greater volatility, meaning their prices can fluctuate significantly in the short term. Bonds, on the other hand, are typically considered lower-risk investments, providing more stable returns but with less potential for significant growth. Understanding your own risk tolerance, that is, your ability to withstand fluctuations in the value of your investments, is crucial when building your investment strategy. So, where should you start if you're new to investing? The first step is to establish your financial goals. What are you investing for? Is it for retirement, buying a home, your children's education, or simply to grow your wealth over time? Your goals will play a significant role in determining your investment strategy, including the types of investments you choose and your time horizon. The length of time you expect to hold your investments before needing to access the money. For long-term goals, such as retirement, you can afford to take on more risk because you have time to ride out market fluctuations. For short-term goals, you'll want to focus on more conservative investments to preserve your capital. Once you've established your goals, the next step is to understand the different types of investment options available to you. The most common types of investments include stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate. Each of these assets has its own characteristics, benefits, and risks. Stocks represent ownership in a company. When you buy a stock, you're purchasing a small piece of that company, and as a shareholder, you can benefit from its growth in the form of capital appreciation, which is the stock's price increasing, and dividends, which are a portion of the company's profits distributed to shareholders. Stocks are known for their potential for high returns, but they also come with high risk, as their prices can be volatile. Bonds are essentially loans you make to a government or corporation. In exchange for your investment, the issuer promises to pay you interest over the life of the bond, and to return your principal when the bond matures. Bonds are generally considered lower-risk investments than stocks, providing more stable, predictable returns. However, they typically offer lower potential for growth. Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. When you invest in a mutual fund, you're buying shares of the fund, and your return is based on the performance of the fund's holdings. Mutual funds are managed by professional fund managers, making them a good option for investors who prefer a hands-off approach. They offer diversification, which helps spread risk, but they also come with management fees that can eat into your returns. Exchange-traded funds, or ETFs, are similar to mutual funds in that they hold a diversified portfolio of assets. However, ETFs trade on an exchange like individual stocks, meaning you can buy and sell them throughout the trading day at market prices. ETFs often have lower fees than mutual funds and provide an easy way to gain exposure to a broad range of assets, making them a popular choice for both beginners and experienced investors. Real estate is another common investment option, offering the potential for income through rental properties or capital appreciation as property values increase. Real estate investments can be more complex and require a significant upfront investment, but they also provide diversification beyond traditional financial markets. Additionally, real estate investments can offer tax advantages, such as deductions for mortgage interest and depreciation. Once you're familiar with the different types of investments, the next step is to decide how to allocate your money across these assets, a process known as asset allocation. Asset allocation is one of the most critical decisions you'll make as an investor, because it determines the balance between risk and reward in your portfolio. A well-diversified portfolio spreads your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk and increase the likelihood of achieving your financial goals. For beginners, a common approach to asset allocation is to use a mix of stocks and bonds that aligns with your risk tolerance and time horizon. For example, a younger investor with a long time horizon might choose a portfolio with 80% stocks and 20% bonds, taking advantage of the higher growth potential of stocks. An investor closer to retirement, on the other hand, might opt for a more conservative mix, such as 40% stocks and 60% bonds, to protect their wealth and generate stable income. Another key principle of investing is diversification, which involves spreading your investments across a variety of assets to reduce risk. The idea is that by investing in a range of assets, such as different industries, geographies, and types of securities, you're less likely to be negatively impacted by the poor performance of any single investment. For example, if you only invest in technology stocks and the tech sector experiences a downturn, your entire portfolio could suffer. But if you diversify by also investing in bonds, real estate, and international stocks, your losses in one area may be offset by gains in another. Now that you have a basic understanding of investment options, asset allocation, and diversification, it's time to consider how to actually start investing. One of the easiest ways to begin is through a brokerage account, which allows you to buy and sell a wide range of investments, including stocks, bonds, mutual funds, and ETFs. There are many online brokerage platforms available today that offer low fees, user-friendly interfaces, and educational resources for beginners. Some popular options include Vanguard, Fidelity, and Charles Schwab. Many of these platforms also offer robo-advisors automated services that create and manage a diversified portfolio for you based on your risk tolerance and goals. If you're investing for retirement, consider starting with tax-advantaged accounts like a 401(k) or an IRA, which stands for Individual Retirement Account. These accounts offer significant tax benefits, such as tax-deferred growth or tax-free withdrawals in retirement, depending on the type of account you choose. With a 401(k), your contributions are typically made through payroll deductions and may be matched by your employer, making it an excellent way to build retirement savings. An IRA, on the other hand, is an individual account that offers more flexibility in terms of investment options and contributions. It's also important to establish a regular investing habit. One of the most effective strategies for long-term investing success is dollar cost averaging, which involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. This approach reduces the impact of market volatility on your portfolio, as you're buying more shares when prices are low and fewer shares when prices are high. Over time, dollar cost averaging can help smooth out the ups and downs of the market and build wealth steadily. As you begin your investing journey, it's crucial to stay informed and continue learning. The financial markets are constantly evolving, and staying up to date on economic trends, investment strategies, and market conditions can help you make better decisions. Consider reading books, taking online courses, or following reputable financial news sources to deepen your understanding of investing. Remember, successful investing is a marathon, not a sprint. And the more you learn, the better equipped you'll be to navigate the challenges and opportunities that arise. Finally, it's important to monitor your investments regularly and make adjustments as needed. While it's essential to avoid making impulsive decisions based on short-term market fluctuations, it's also important to periodically review your portfolio to ensure it remains aligned with your goals and risk tolerance. As your life circumstances change, for example, if you get married, have children, or approach retirement, you may need to adjust your asset allocation or investment strategy. Regularly rebalancing your portfolio, which involves buying or selling assets to maintain your desired asset allocation, is a key part of long-term investment management. In conclusion, investing is a powerful tool for building wealth and achieving your financial goals, but it requires knowledge, discipline, and a long-term perspective. By understanding the basics of investing, setting clear goals, choosing the right investments, and staying informed, you can create a strategy that works for you and puts you on the path to financial success. Remember, the earlier you start investing, the more time your money has to grow, so don't wait. Take that first step today. As you continue on your financial journey, don't forget to subscribe to our channel for more in-depth guides on investing, personal finance, and wealth-building strategies. Thank you for watching, and we'll see you in the next video, where we'll explore more ways to achieve your financial goals and build a secure, prosperous future.